This book you are about to hear is not a collection of fragmented advice. It is a purposeful compilation of insights derived from Warren Buffett's shareholder letters, a thematic structure curated and introduced by Lawrence A. Cunningham. It consistently presents a philosophy of thinking like an owner, using economic standards for valuation, and exercising discipline in capital allocation from corporate governance, finance, investment, instrument selection, common stock policies, mergers and acquisitions, all the way to valuation, accounting, and taxation. Each section is a slice, but the overall picture is a system for responsible business operation and investing in an open economy. So, if intrinsic value is merely the discounted value of cash flow available to owners, why does the market patiently bid for illusions? And you, the diligent reader, what habits will you be ready to abandon before delving into this book? Belief in reported profits, the comfort of smooth models, or the false sense of security derived from diversification without understanding? Part 1. Corporate Governance. That night, I sat with my own writings, contemplating what is called corporate governance. Many mistakenly believe it to be merely dry clauses, a tedious legal framework interesting only to lawyers. But to me, it is the heart, the lifeblood of a company. Because there, the owners, the shareholders, and the operators, the management, seek to coexist, sharing benefits, responsibilities, and even fears. I have witnessed numerous powerful companies collapse, not because of poor products, but because those at the helm concealed the truth. Transparency, therefore, is not an option, it is breath itself. Imagine you invest capital in a ship, and the captain reports calm seas and clear skies, while below deck water has already poured in. By the time you discover the truth, it's too late. Governance is about ensuring the owner knows the true condition of their ship. In the letters I send to shareholders, I always write as if speaking to a friend seated across from me, unembellished, unadorned. For me, financial reports are not for display, but to tell what we did this year, where we went wrong, and what we learned. If we conceal, we only deceive ourselves. The truth might be hard to swallow, but it is the only medicine that helps a business grow. But transparency alone is not enough. There's a bigger question: who oversees the helmsman? The board of directors is created for that very purpose. Unfortunately, in many companies, they act merely as rubber stamps. The CEO presents something, and they sign it. I believe such a board is more dangerous than having no board at all, as it creates the illusion that someone is protecting the shareholders. A truly effective board must have members who dare to ask questions, dare to object, and most importantly, are not bound by personal interests. I have often said that I prefer those on my board of directors to have real money invested in the company's stock. That way, they feel my pain, share my worries. If they only receive remuneration, they will never truly understand the sleepless nights when the stock plummets, or the trembling joy when the company's value rises due to a wise decision. Change in a business always brings anxiety. I have seen many companies die slowly because of the very changes they initiated. A new CEO arrives, wanting to prove themselves with a bold strategy, but forgets the foundation that sustained the company for so many years. Change might be necessary, but if it only serves to satisfy ego, the price paid is the life of the business. Shareholders are often the ones who ultimately bear the consequences. I recall a time when a company in our portfolio decided to venture into an area where they had no experience. The simple reason: management wanted to make their mark. The result: hundreds of millions of dollars vanished. The ones who suffered the most were not the CEO but the shareholders. They lost money, while the executives kept their positions and bonuses. That is precisely what bad governance causes. And the story doesn't end within the company. A company lives within society, and society has a right to expect things from that company. But I never believed in flashy, self-promotional charity campaigns. When management uses shareholder money to fund projects they personally find appealing, they turn the company into their personal piggy bank for their own reputation. I believe that if a company earns fair profits, it should return them to the shareholders. Then each shareholder can decide what to do with that money: hold it, reinvest it, or donate it to charity according to their beliefs. That is fair. The same applies to executive compensation. I have seen bonuses of hundreds of millions of dollars for CEOs just because the company still existed. That's like paying a doctor because the patient hasn't died yet. Compensation must be tied to the real value that management creates, not to superficial, embellished numbers. We apply a simple principle. If a unit you manage outperforms its assigned capital, you receive a deserving bonus. If not, you get nothing extra. There are no shortcuts, no smokescreens. But above all, there is something more precious than money: reputation. A company can take decades to build trust, but only a second to lose it. I have repeatedly told my managers, do everything as if your name will appear on the front page of tomorrow's newspaper. If that makes you ashamed, then don't do it. Profits may come and go, but once a reputation is lost, it can never be regained. Corporate governance, therefore, is not just a power chart. It is a commitment to shareholders, to employees, to society, and to the conscience of the leader themselves. We can make mistakes, but we must not betray trust. If you think of a business as a living organism, the board of directors is its immune system. A healthy body is not immune to all bacteria, but it is capable of fighting back when bacteria invade. Governance is the same. The business world is full of pitfalls. Numbers can be manipulated, contracts can be misrepresented, investment decisions can be driven by arrogance. The board of directors exists to detect, question, and eliminate these risks before they spread throughout the entire body. But sadly, many boards are like weakened immune systems. They are chosen for connections, for their pliability, rather than for their independent spirit. A clever CEO can turn the board into an applauding audience instead of a referee. And when that happens, shareholders, the true owners of the company, become outsiders in their own assets. I always believe that to know if a board is strong or weak, you only need to look at one thing. When the CEO is wrong, does anyone dare to stand up and object? If everyone remains silent, you can be sure that the company is on a dangerous path. As for transparency, perhaps nothing is easier to understand than an image. Imagine you hire a herdsman for your buffaloes. Every evening, he reports that the herd is complete and healthy. But one day, when you visit the pasture, you find several buffaloes emaciated, one missing. How would you feel? Business is the same. If financial reports are just for embellishment, they are no different from a foggy mirror concealing the truth. And when the truth is exposed, lost trust is very difficult to regain. I write annual reports as if you are talking to a relative who is not a financial expert but has a sharp mind. This means eliminating ambiguity, getting straight to the point, no circumlocution. Shareholders don't need to hear flowery stories. They need to know if the company is healthy or sick, on the right track or lost. Here you will find an interesting point. Good governance is not complicated. It doesn't require mysterious formulas or convoluted jargon. It only requires honesty, clear-headedness, and a bit of courage. But precisely, these simple things are often overlooked because people easily fall into complacency and ambition. Let's talk about executive compensation. There are times when I find it like a farce in many companies. CEOs receive tens of millions of dollars annually, regardless of how the company performs. If results are good, they declare, "I deserve this." If results are bad, they justify it. "The general situation is difficult, it's not my fault." What about the shareholders? They only bear the burden. We choose a different path. We design compensation to align managers' interests with shareholders' interests. If the company under your leadership exceeds expectations, you will be justly rewarded. But if results are poor, you get nothing extra. There's no such thing as getting a share just because you're in the right seat. That's fair, and that's what truly motivates managers to put their heart and soul into creating value. And above all, I want to reiterate the story of reputation. A company can suffer losses in a quarter or even a year, but if it loses its reputation, the cost is immeasurable. We have sometimes rejected investment deals promising enormous profits simply because they risked damaging Berkshire's reputation. I tell my associates, don't do anything you wouldn't want your name associated with on the front page of tomorrow's newspaper. That's not just an empty ethical philosophy. It's smart business strategy because trust is the most enduring asset a company can possess. Many ask, what about social responsibility? I don't deny that businesses have a role in the community, but I also don't believe in management arbitrarily using shareholder money for personal charitable preferences. If you want to do charity, use your own money, not others. Social responsibility, in my view, begins with treating employees, customers, and the surrounding community fairly. Produce good products, pay fair wages, keep promises to customers. That is true charity. Governance, therefore, is not a power game, nor a stage for moral display. It is an unwritten contract. Shareholders place their trust, and leadership must be worthy of that trust. All grandiosity is meaningless if that fundamental truth is forgotten. I recall many times in the past when large companies collapsed. People often blamed difficult markets or unexpected volatility. But if you look closely, the real cause often lay within. Information was hidden, boards of directors were lax, compensation was skewed, and reputation was eroded bit by bit. Then, at some point, it all accumulated into a bomb. When it exploded, everyone realized in horror, but it was too late. That is why I always believe that governance is not a procedure, but the art of keeping a business alive and enduring. If you disregard it, you might go very fast in the short term, but you will stumble heavily in the long run. Imagine you are a small shareholder in a giant corporation. You put your money into it, but you don't manage it directly. The managers are the CEO and the management team. You can't sit in the company office every day to verify what they're doing. Therefore, you need a mechanism to protect yourself. That mechanism is the board of directors, people placed in a position to act on your behalf, to question, to scrutinize, to halt decisions that could harm your assets. If that mechanism breaks down, you are completely exposed to risks. In one exchange, I once said, choose managers whom you trust will act in your best interests, even if it goes against their own. That's a high standard, but necessary because conflicts of interest always exist in business. Managers want more power, more bonuses. Shareholders want sustainable profits, less risk. Only when the board of directors is strong enough to balance these can the company avoid deviation and risk. That is something that always lurks. I'm not talking about market ups and downs or economic recessions, but risks that come from the people within the company itself. A wrong decision, an unethical act, a murky report. Just one such thing is enough to wipe out years of achievements. What worries me most is not red numbers on a report, but the question, is my company maintaining its integrity? Reputation, as I mentioned, is something that cannot be bought back once lost. You can build it over decades, but it only takes a few foolish minutes to destroy. I want every manager at Berkshire to engrave that in every decision, from signing a small contract to acquiring a large corporation. I also want to add a paradox. Sometimes the best way to protect shareholders is to give them freedom. That's why I oppose companies arbitrarily deciding to donate money on behalf of shareholders. I don't deny the value of giving, but I believe everyone has the right to choose their own way. Using collective money for personal endeavors, even under the guise of charity, is a form of abuse of power. And abuse of power, if tolerated in one place, will spread to others. So, for me, governance is not just an academic concept. It is a silent but continuous battle to keep the company honest, fair, and worthy of the trust that shareholders place in it. Imagine a ship sailing across the ocean. Shareholders are those who bought tickets and entrusted their faith in the captain. The captain is the CEO. The board of directors are the navigators standing on the deck, looking far towards the horizon, ready to take the helm when the ship veers off course. If the navigators fall asleep, if they only concern themselves with befriending the captain, that ship could hit a hidden reef at any moment. In business, there will always be storms, big waves. You cannot control the sea, but you can control how you steer the ship, and a good governance system is the strongest rudder. I write these things not to teach anyone, but to remind myself and those who care. Sustainable success doesn't begin with grand deals, but with simple yet unwavering principles. Be transparent, be fair, respect reputation, reward and punish justly, and always remember that ultimately, you are only holding assets in trust for shareholders. When we uphold these things, a business not only survives but can endure through generations, beyond the grasp of temporary individuals, to become a long-lasting living entity. That is the true meaning of corporate governance. Part 2, Finance and Investing. When I talk about investing, I often borrow the image of a peculiar neighbor, Mr. Market. Every day he knocks on your door, holding out a piece of paper with a number. Today, he's willing to buy your shares at this price or sell them back to you at the same price. Tomorrow, the same Mr. Market, but in a different mood, offers a completely different number. Sometimes that number is ridiculously high, reflecting blind euphoria. Sometimes it's tragically low, as if the world is about to end. Most people let Mr. Market lead them. They are swept along by fear when he panics, or they rush in when he's excited. But you are not obliged to do that. You can ignore him until you spot an opportunity. When he is too pessimistic, you buy at a cheap price. When he is too naive, you let him confidently bid high. Smart investing, in fact, is nothing more than knowing how to behave calmly in the face of these erratic emotions. The biggest trap for investors lies not in the market, but within themselves. A mind driven by fear or greed will see the market as a mirror reflecting emotions. Mr. Market is just a distorted mirror, and you are the one who decides whether to believe it or not. That's what Graham taught me, and is the guiding principle I have carried throughout my journey. From these everyday stories, we move to a seemingly dry field, arbitrage. Many think it's just for bankers, but to me, it's simply taking advantage of discrepancies the world overlooks. When a company announces a merger, its stock price often fluctuates strangely. The stock of the acquired company rises, but doesn't reach the acquisition price because people still doubt whether the deal will succeed. In that gap, the patient investor finds opportunity. Arbitrage is not like gambling in a casino. It's based on logic, on probability, and on an understanding of the rules of the game. Sometimes profits don't come from the market being wrong, but from the market not having adjusted yet. Of course, not every deal is perfect, and there have been times when I paid the price for a failed merger. But what's important is that lesson taught me that money should only be placed where reason can measure, not where the heart pounds frantically on Wall Street. Dogmas are often repeated on Wall Street like a tiresome chorus. The market is always efficient, they say. Maximum diversification is the safe path, they advise. But in reality, blind faith in these mantras leads to failure. If the market is always efficient, where are the opportunities for anyone? If diversification is blind, people are simply accumulating hundreds of items in a basket without understanding which ones have value. I call those cloaks worn to conceal a lack of knowledge. The concept of value investing that people often use is actually redundant. If it's called investing, it cannot be without being based on value. If you don't care about intrinsic value, you're not an investor, you're just a gambler. The term value investing is merely to re-emphasize something inherently obvious. But because people have turned buying stocks into a betting game, I am compelled to repeat it. A smart investor, therefore, does not necessarily need an IQ of 150 or a glittering degree. What he needs is the ability to go against the crowd, to keep a clear head when the market loses its mind. Intelligence lies not in scores but in discipline and a cool head. And this, ironically, is so rare that I find it astonishing. Most failures in the market don't come from a lack of knowledge, but from a lack of discipline. There was a time when I too made mistakes. I went hunting for companies like cigar butts, so cheap they were almost free, but in reality only had enough left for a few last puffs. Initially, that strategy yielded profits, but gradually I realized it was not a long-term path. A dying business, no matter how cheaply acquired, only brings more worries than joy. The further I went, the more I understood that money must be entrusted to where it can grow, not where it's about to breathe its last. More dangerous still is institutional imperative. A company often acts not out of reason, but out of habit, peer pressure, or fear of going against the majority. Wrong decisions then follow one another like a domino effect, and any unwary investor will be swept away by that current. Debt, many consider debt a tool, a springboard to accelerate profits. True, in the short term, leverage can help you soar. But I always picture debt like oxygen. When it's abundant, we barely notice it, but when it's scarce, just a few breaths can determine survival. How many once-proud businesses have collapsed simply because they took on more debt than they could handle? I witnessed it, and I've never forgotten. I once realized a bitter paradox. A business that shows profits on paper hasn't necessarily created real value. Accounting profits often resemble a distorted mirror, reflecting an image people want to see, not the true essence. I learned to read financial reports not like a song, but like a script. This script has main characters' revenue, profit, but also countless small details hidden in the footnotes, where the truth often conceals itself. The clearest example is depreciation. A steel manufacturing plant might report stable profits annually. But if you ignore the cost of replacing machinery as it wears out, that number is merely an illusion. I never want to build an empire on illusions. $1 of reported profit can be vastly different from $1 of actual profit flowing into shareholders' pockets. The investor's job is to see through that smokescreen. In the world of investing, people are often tempted by growth that appears beautiful on the surface, like a big wave. It promises to carry you far, faster than all others. But a big wave can also drown you if you don't know how to ride it. I've seen countless companies chase growth numbers and forget their fundamentals. Is the competitive advantage sustainable? Is the business model simple? Is management honest? Growth based on debt or temporary luck is merely a sandcastle on the seashore of investing. Therefore, investing is not about hunting for temporary beauty, but patiently finding businesses that can withstand storms. If a company can generate stable cash flow, not dependent on luck or cycles, that is the gem. And the miracle is that when you own a true gem, time becomes your greatest ally. Wall Street hates patience. They want everything fast, immediately, every quarter must be perfect. And to satisfy this craving, many companies choose an artificial path, embellishing reports, borrowing to buy back shares, or even deceiving investors with empty promises. I have never seen that game end well, because eventually, true value will surface like a piece of wood floating in the ocean. One of the truths I've distilled is that value does not come from complexity. On the contrary, I always look for businesses that even a child can understand. Coca-Cola sells soft drinks, Gillette sells razors, the Washington Post sells information. This simplicity is a compass. If I cannot explain a company's business in 10 minutes, I don't buy it. Because if it takes an army of analysts and piles of Excel models to understand, the hidden risks are usually greater than the potential profits. I remember the first time I read a report from a complex investment bank, pages crammed with formulas, numbers, models for valuing derivatives. After reading it, I felt like I was in a maze, and I understood that whenever I felt lost, the answer was not to try to be smarter, but to step back. I passed on that opportunity, and looking back, it was one of the wisest decisions of my life. There were also times when I went against trendy currents. While many rushed to chase new era companies, I chose businesses that seemed old-fashioned. But I wasn't looking for glamour. I was looking for endurance, like an ancient tree, seemingly quiet, slow, but deeply rooted in the earth, weathering all storms. And this is where the concept of diversification is misunderstood. People say, scatter your money into many companies to reduce risk. To me, that's just a way of covering up a lack of knowledge. I'd rather put my money into a few companies I understand inside and out than scatter it everywhere like salt on a desert. Blind diversification turns you into someone who owns everything but nothing truly. A friend once asked me, "How can you be so sure when betting on only a few businesses?" I replied, "Because I know them well, like I know my own family members. I know their strengths, their weaknesses, even their scars." That's not recklessness, it's trust built on understanding. And that trust has never failed me. If I choose correctly, of course. No one is immune to mistakes. I have bought companies that seemed perfect, only to realize management was dishonest. A leader lacking integrity can destroy a treasure in just a few years. So, in every analysis, the human factor is always at the core. I can forgive a less attractive business model, but I will never forgive dishonesty. To succeed in investing, you don't have to do too many things right. You just need to avoid serious mistakes, just like driving long distances. You don't need to speed, you just need to avoid driving into a ditch. In investing, one fall can wipe out decades of gains. So, avoiding deadly risks is far more important than seeking maximum returns. Time is the harshest filter. You can fool the market for 1 year, 2 years, even 5 years. But after 10, 20 years, only companies with real value will survive. All the makeup eventually washes off, revealing the true face. And the wise investor is patient enough to wait until then. If there's a secret formula for investing, it lies in the combination of reason and discipline. Reason to clearly see the difference between price and value. Discipline to not be swept up by the crowd, even when everyone is cheering as if at a festival. Wall Street is where fevers flare up and then fade. Today, people celebrate a new internet company. Tomorrow, they switch to energy stocks. The day after, it's a biotech startup. Money chases the lively drumbeats, but then abandons the ruins in its wake. I've learned to stand outside these fevers, not because I'm smarter, but because I understand that collective emotion is the investor's greatest enemy. One of the principles I repeatedly emphasize is, be fearful when others are greedy and greedy when others are fearful. It sounds simple, but to do it, you must accept loneliness. When the market is red, everyone panics and sells off. You are the only one quietly buying. And when stock prices climb, the cheering crowd rejoices, but you are the one quietly leaving. If you cannot endure that loneliness, you cannot be an investor. I clearly remember the early 1970s when blue-chip stocks were in freefall. Many called it the end of the market. But to me, it was a discount sale. Good companies suddenly became ridiculously cheap. I accumulated them. Of course, at that time, people looked at me as if I were crazy. But a few years later, when the storm passed, the profits proved everything. However, opportunities don't always come from collapse. Sometimes they come from the most ordinary things. I don't need miraculous inventions. I need products that people will still use in 10, 20 years. A can of Coca-Cola, a razor blade, a morning newspaper. These seemingly mundane things are precisely the gold mines. The paradox lies in this. The more investors complicate things, the more easily they get lost. Simplicity and clarity bring sustainable strength. More than once, I've seen large investment funds with hundreds of experts fail heavily. Meanwhile, a farmer, if he knows how to hold the stock of a good company, can become wealthy. Because the essence of investing lies not in degrees or mathematical models, but in the ability to control greed and fear. A question I often receive is, how do you know when to sell a stock? I often reply, if you're not willing to hold it for 10 years, don't hold it for 10 minutes. For me, selling only occurs when two conditions are met. Either the business no longer maintains its competitive advantage, or I find a clearly better opportunity. Otherwise, all short-term price movements are not enough to sway us at Berkshire. We also avoid speculative games, derivatives, quick trades, and buying-selling on rumors. All of these do not create sustainable value. It's like gambling in a casino. The longer you play, the more certain you are to lose. We choose to build a castle brick by brick, rather than building a castle of sand. But perhaps the most important lesson I want to share is the relationship between money and time. Money can grow, but only if you give it time. A seed cannot become a tree overnight. You have to sow, nurture, and wait. Wealth is the same. It is a product of time, of accumulation, of compound interest. And compound interest, as I once said, is the eighth wonder of the world. You have $1, and it grows by 20% annually. After 30 years, you no longer have just a few tens of dollars, but a fortune. But the condition is that you must be patient enough to wait 30 years. Most people fail not because they choose the wrong company, but because they are not patient enough to wait. And that is why I view the stock market as a machine for transferring money from the impatient to the patient. No image is more accurate. Every day there are millions of buying and selling decisions, millions of noises, but ultimately the reward belongs to those who are quiet enough to sit still. I don't believe everyone needs to become a copy of me. I just want to point out that the path to success in investing is not about finding new secrets, but about holding onto simple principles, repeating them, and not betraying them. Investing, after all, is not a game of supreme intellect, but a game of character. Part 3. Other investment choices in Warren Buffett's eyes. The world of investing, in Warren Buffett's eyes, resembles a giant market. Each stall displays wares called alternative investment opportunities. At first glance, they seem diverse and glamorous. Bonds, stocks, preferred securities, derivatives, foreign currencies, even the house you live in. But Buffett doesn't stand in the market with the eager eyes of a consumer. He walks slowly, looks deeply, then asks, what is the true value of this item, and will it help me preserve my purchasing power in the next 10-20 years? He begins by dividing the entire investment universe into three main groups. First, asterisk currency-pegged assets asterisk like government bonds, treasury bills, or savings accounts. These assets seem safe. You lend money to the government, and they promise to return both principal and interest. However, Buffett warns that this safety can sometimes be a sweet trap. Because in reality, over many decades, the yields from these currency-pegged instruments often aren't enough to offset inflation. You receive the nominal amount, but when you go to buy goods, you find your purchasing power has eroded. The second group, asterisk stocks asterisk. Here, Buffett calls them productive assets because each share represents a part of a real business machine that creates goods, services, and profits. Unlike bonds, their intrinsic value can grow over time along with the growth of the economy. Buffett considers stocks the most fertile ground for patient investors. The third group, arbitrage and special commitment forms asterisk. This is the playground for those who hunt for temporary market discrepancies. A merger, a convertible bond issuance, a price difference between two markets. For Buffett, this group is like a temporary fair, only occurring when unusual opportunities arise and requiring iron discipline. After outlining the playing field, Buffett leads us to the first stall, junk bonds asterisk. He recalls the 1980s and 1990s when Wall Street was flooded with the dogma that merely diversifying a portfolio of risky bonds would yield rewards as if you were the house in a casino. But life isn't that simple. Such portfolios often collapsed when the economy changed. Buffett witnessed many institutions believing they were smarter than the market, only to pay a steep price. For him, evaluating bonds cannot rely solely on modeled numbers. One needs to look at the living organism of the business, at its actual cash-generating ability to repay debt. Otherwise, bonds promising 12% yields turn out to be just invitations to a bankruptcy party. Moving to asterisk zero coupon bonds asterisk, Buffett shares practical experience. Berkshire once issued a type of zero coupon bond with conversion rights. The principle is simple. Investors put in money today, receive no periodic interest, but at maturity, they get the par value plus the option to convert into shares. In theory, it's an attractive product that appeals to investors' preference for discounts, but Buffett recounts how often zero-coupon bonds become distorted. They conceal debt burdens, making financial reports appear healthy. Investors dream of miraculous returns, while in reality, it's just a loan with layered risks. Buffett then mentions asterisk preferred stock asterisk. This is a hybrid form, half stock, half bond. Holders receive fixed dividends but lack the control rights of common shareholders. Buffett approaches this instrument not with rigid formulas, but according to specific circumstances. He once bought preferred stock in struggling banks, receiving stable dividends along with conversion rights. Here, Buffett wants to teach that any instrument can be useful if you understand how it works, and only use it when the balance of benefits favors you. We pause here to breathe, because ahead lie two thornier terrains, asterisk derivatives asterisk, foreign currencies asterisk, and foreign stocks asterisk. And finally, asterisk home ownership asterisk. Buffett will lead us directly into these, even the dark corners where Berkshire itself had to diffuse derivatives. Asterisk derivatives asterisk are often called financial weapons of mass destruction. The phrase sounds dramatic, but Buffett is not joking. Derivatives were born from legitimate needs, farmers wanting to hedge wheat prices, airlines wanting to fix fuel costs. But then, like everything else on Wall Street, the original tool transformed into a casino options, futures, credit default swaps. All of these created layers upon layers of paper, where each player only saw their part. No one truly saw the entire systemic risk. When Berkshire took over General Ray in the late 1990s, Buffett inherited a derivatives vault containing thousands of contracts. Many of them stretched for decades, linked to counterparties across the globe, and came with countless complex conditions. He admitted that closing these contracts was like defusing a bomb he hadn't built, taking nearly a decade for Berkshire to unravel that tangled mess. From this experience, Buffett concludes that derivatives blind both sellers and buyers. Sellers think they're collecting fees like the house. Buyers believe they're purchasing safety. But both often overlook the core point. The financial system can collapse in a chain reaction when these commitments pile up and no one can keep their promises. For Buffett, the principle is clear. If you don't understand it and can't control it, stay away. Foreign currencies and foreign stocks asterisk. Buffett is frank that he doesn't play the game of predicting exchange rates. Currency speculators often resemble people standing on a wet beach, constantly drawing lines and cheering whenever a wave washes them away. Buffett says, Currency is a government's promise, and history shows that most governments are not good at keeping that promise. However, he is not entirely indifferent. In the early 2000s, Berkshire Hathaway did bet against the dollar by holding other strong foreign currencies. The reason wasn't that Buffett wanted to be a prophet, but because he saw a long-term trend: massive U.S. budget and trade deficits. He viewed this as a form of defense, not a quick money-making scheme. It's noteworthy that Buffett rarely steps outside his home turf. Most of Berkshire's assets remain tied to U.S. businesses that he understands well, rather than blindly chasing globalization trends. Home ownership asterisk. This is where many are surprised because Buffett doesn't consider personal home ownership an investment, but simply a living necessity. He recounts that the house in Omaha, which he bought in the 1950s, is still where he lives today. The value of the house has increased, but what he received is far more precious: stability, joy, and not having to worry daily about market value. According to Buffett, the big mistake many people make is treating their house like a stock, constantly buying and selling, mortgaging and borrowing more to chase speculative dreams. That led to the disastrous housing bubble. For him, a house is a dwelling, not a money-printing machine. If you want to get rich, save your resources for truly productive assets: businesses, stocks, things that can create new value for society. All alternative investment opportunities boil down to two questions. First, can this asset preserve or increase purchasing power over time? Second, is it within my circle of competence and control? If both answers are yes, move forward. If not, leave the stall without looking back. Buffett often observes people with eyes half benevolent, half mocking. He knows everyone wants to find the promised land for their money. Some turn to gold, others embrace bonds. Still others plunge into derivatives like gamblers in a casino. In sum, all chase a sense of security. But the paradox lies in this: the more they crave security, the more they put themselves in danger. He repeatedly reminds us there is no such thing as a perfect asset. Gold sparkles but is unproductive. Government bonds seem certain but depend on the sanity of those in power. Derivatives are sharp tools but can easily become a self-inflicted wound. A home brings peace of mind but can become a nightmare if treated like a stock. And foreign currency, after all, is just a piece of paper that some government promises to keep stable. The common thread Buffett wants to draw is this: most of these alternatives make people lose control. Gold holders don't control its value, they merely watch others price it. Bond buyers tie themselves to the government. Derivative players surrender their souls to intangible contracts, and real estate speculators are swayed by the crowd's frenzy. Invest in genuinely productive businesses where people transform ideas and labor into new value. When you own shares in a good company, you become a companion to the flow of creation, production, distribution, and consumption. Profits come from the vitality of the economy, not from the hope that someone will pay you a higher price tomorrow. Here, Buffett doesn't deny the existence or necessity of other instruments. Gold can be a mirror reflecting inflation fears. Bonds help people achieve fixed income. Derivatives once had a legitimate purpose as risk insurance. Homes provide shelter. But he always offers a lesson: don't let the instrument become the game. Don't let the means deceive you into mistaking it for the end. The story of new generations of investors is also mentioned by Buffett. He recounts how many waves of people have passed through Wall Street, leaving behind different investment mantras. Times have changed, but then the dot-com bubble, the financial crisis, and the real estate bubble all burst, revealing the same old, yet ever-fresh truth: real value is the foundation. All those investment analyses are just masks donned to cover fear and greed. It was patience that kept him away from the derivatives fever, from the currency waves, from the dream of quick wealth from real estate. Patience is not sitting still, but actively refusing what you don't understand. In the world of investing, saying no many times is often more important than saying yes. And perhaps the most captivating thing about Buffett's words is not in financial techniques, but in the tone of an experienced elder. He talks about money as if talking about life. Every investment decision reflects character. Choosing gold is choosing faith in something immutable. Choosing bonds is entrusting oneself to the government's discipline. Plunging into derivatives is being swept away by the illusion of power. Speculating in real estate is chasing the crowd. But choosing a business, for Buffett, is choosing faith in people and their ability to create value. There are lands filled only with quicksand. There are paths that seem short but lead into the desert. If you want to go far, choose the path less traveled, the path of patience, understanding, and faith in true value. Part 4. Common stocks. In the world of finance, where numbers constantly move like tides, there is a quiet truth that most investors overlook: transaction costs. Buffett calls it the invisible price the entire economy pays as money incessantly flows through brokers, fund managers, and all sorts of intermediaries. In the first subsection, he presents a witty but allegorical story: the G-Zaks family. This family owned all businesses in the U.S., meaning they enjoyed all the profits. But then, individual members were persuaded by intermediaries that they could optimize their assets by buying, selling, swapping, and reorganizing. The result was that the original intact profits began to be chipped away, little by little, flowing into the pockets of the intermediaries. The more transactions, the more commissions, the more management fees, the smaller the slice of pie remaining for the G-Zaks family. Buffett estimates that these costs alone have eroded nearly 20% of the accumulated profits of businesses across the economy. Viewed from afar, this is like a collective disease. We are too quick to believe that frantic activity, constant buying and selling, is a sign of intelligence, when in reality it is a waste of energy. Buffett doesn't use sarcasm, but his bluntness makes the reader start. Every time we click buy or sell, let's remember that a portion of our profit has instantly left us, not to create value, but to feed the ecosystem of intermediaries. For Berkshire, the message is clear: limit transactions, hold for the long term so that intrinsic value can grow naturally. This approach not only preserves shareholder interests, but also reduces the negative impact of the transaction addiction that has become part of Wall Street culture. Moving to the next subsection, Buffett discusses attracting the right kind of investor. Berkshire doesn't want shareholders who come and go, treating stock as a ticket to short-term gains. He wants true partners, those willing to share the company's long-term journey. To achieve this, Berkshire designs its messages, annual reports, and financial policies to appeal to those who see themselves as co-owners, not transient visitors. A true shareholder is someone who co-owns the business, patiently awaiting for intrinsic value to be reflected in the long run. Berkshire actively keeps its stock turnover low as a signal to the market that this is not a place for those eager for a quick hit. You can imagine Buffett building a small but cohesive community where interests are built on a sustainable foundation, not on price manipulation. The next key issue is dividend policy and share buybacks. Buffett introduces a principle that later became legendary: the simple yet rigorous $1 test. Every dollar of retained earnings must create at least $1 of market value. If not, return it to shareholders as dividends. This way, the company forces itself to be honest in capital allocation. Money should not be kept merely to inflate the balance sheet or to fuel management's pride. In parallel, share buybacks are only justified if the purchase price is lower than intrinsic value. If a company buys back its stock when it is overvalued, this action is nothing more than transferring money from the pockets of remaining shareholders to the pockets of departing shareholders, an unfair game. Buffett also criticizes many companies that buy back shares merely to counteract dilution from stock options or to prop up the price in the short term. These strategies look good on paper, but create no real value. Stock splits. Many companies do this to lower the par value, making the stock seem more accessible, thereby increasing liquidity. But Buffett views it entirely differently. A split only makes trading more active, generates more fees, and attracts short-term speculators. Berkshire adamantly maintains its stock structure because true value lies not in a low or high par value, but in the company's sustainable earnings. According to Buffett, splitting shares is like superficial grooming that weakens the bond with long-term shareholders. If in the previous section Buffett talked a lot about the philosophy of limiting transactions and choosing the right partners, in the following subsections he goes straight into the strategies shareholders often adopt and how Berkshire views them. First, the perspective on shareholder strategy. Buffett observes that many companies constantly try to please all shareholders, from patient long-term investors to those only concerned with the next quarter's numbers. The result is that they get lost, wanting to pay dividends, retain earnings, buy back shares, and make risky investments all at once, often in conflict with each other. Buffett believes this is a fundamental mistake. A business cannot be a multifaceted cake. It must choose a clear path. At Berkshire, the shareholder strategy is established as a long-term covenant. The company does not promise quarterly stock price increases, nor does it strive to please Wall Street with short-term numbers. Instead, Berkshire commits that retained earnings will be used to increase intrinsic value, and all shareholders are viewed as co-owners, willing to navigate market ups and downs together. Buffett uses the image of a marriage. If you choose to commit, you must be ready for difficult times, not just sunny days. Then Buffett discusses a highly sensitive topic: shareholder voting rights and capital structure. He recalls the 1980s when a wave of debt-financed corporate takeovers swept through Wall Street. Many companies then rushed to change their capital structure, issuing different classes of shares with varying voting rights to protect management from takeovers. Buffett strongly opposed this. If a business creates real value, it doesn't need artificial armor. Conversely, diluting shareholder power only erodes trust. From here, he leads the reader into one of Berkshire's historical decisions, recapitalizing by issuing Class B shares. This decision was made not to protect the company from a takeover, but to protect small shareholders from market scams. At that time, many funds began offering unit trusts, bundled products that aggregated Berkshire shares and resold them at double their true value, preying on the psychology of those who couldn't afford a single, very expensive Class A share. Buffett and Charlie Munger clearly saw this injustice. Instead of letting intermediaries profit, they issued Class B shares with a much smaller par value, allowing small investors to participate directly without going through deceptive products. Here, Buffett maintains the principle of fairness. Class B shares have fewer voting rights but are straightforwardly priced, without embellishment. This policy was announced transparently with a clear explanation. Berkshire does not want anyone to get rich by exploiting the trust of small shareholders. The story of Class B shares reveals an important difference about Berkshire. The company doesn't follow market trends, but chooses to solve problems at their root. Instead of deterring small investors with the sky-high price of Class A shares, Buffett opened a fairer door, allowing anyone who truly believes in Berkshire to participate, regardless of how much money they have. This also exemplifies the win-win management philosophy. Shareholders are protected, the company maintains its reputation, and no one is left behind. On a deeper level, Buffett implicitly criticizes Wall Street's financial culture, where most companies only seek to maximize benefits for management or large speculators. Berkshire chooses to build strong relationships with each shareholder, viewing them as partners, not prey. For Buffett, a stock is not a chip on a chessboard, but a passport to embark on a long-term journey with a business. After addressing the Class B share story, Buffett expands his discussion to another issue: intrinsic value versus market price of a stock. He frankly points out that the market can conjure strange prices, sometimes cheap as free, sometimes absurdly expensive. But a stock is merely a blurry mirror reflecting reality. The core remains the intrinsic value created by the business. Buying a stock is like buying a field. Every day, a neighbor drops by, yelling a price to buy back that piece of land. One day it's dirt cheap, the next it's sky high. If you only focus on listening to the shouting prices, you will go crazy. But if you know for sure that the field is still fertile, still growing every season, then those shouts are just fleeting winds. For him, a smart investor is not someone who chases prices, but someone calm enough to hold a truly profitable asset for the long term. He also shares his experience witnessing the dot-com bubble in the late 1990s. The market was fervent, tech stocks soared. Many thought Berkshire was too slow and conservative, but Buffett was unmoved because he understood that buying a stock with no real earnings and no sustainable business model was like buying a desert field and hoping for a miracle. Time proved him right. The bubble burst, prices collapsed, but genuinely valuable businesses endured. This steadfastness reflects a common philosophy. Stocks are not a short-term prediction game, but a tool to own a part of a real business. Therefore, Buffett always emphasizes, see yourself as a shareholder, meaning a co-owner, rather than just a gambler on the ticker tape. Loyalty in holding stocks. The majority of investors view stocks as a train ticket buying for one segment, then selling when they see a faster train. He, however, likens stocks to pooling money to build a bridge. If that bridge is solid, spans a river, and creates a flow of commerce, then there's no reason to sell your ownership stake just because someone else is shouting a price outside the station. When discussing Berkshire's own shares, Buffett clearly states that he and Charlie Munger have never cared about short-term stock price fluctuations. They focus on increasing the company's intrinsic value, and the market price will adjust itself over time. If we do things right, the stock will tell its own story. Buffett writes, "Don't look at Berkshire as a speculative tool. If you expect to get rich quickly, go elsewhere." Berkshire is for the patient, for those who see stocks as a bridge to participate in a sustainable business. Buffett emphasizes that he doesn't want shareholders to come and go like hotel guests. He wants them to stay like family in a shared home. Berkshire's prosperity lies not in financial gains, but in the long-term trust between the company and its shareholders. Berkshire stock, for Buffett, is not just a certificate of ownership, but a commitment to a philosophy of life: patience, honesty, and perseverance. Part 5. Mergers and Acquisitions. If there's one area where greed and delusion often lead people astray, it's mergers and acquisitions. Wall Street history is replete with deals touted as game changers that ended in disappointment, sometimes disaster. I've seen countless people walk into negotiating rooms with bright eyes, believing they were getting a bargain, only to sign the death warrant for their own business. In the world of M&A, the most dangerous thing is not a lack of money, but wrong motives. Some executives cannot curb their thirst for expansion. They want to leave their mark by acquiring more companies, regardless of whether it's truly necessary. For them, each deal is a way to satisfy their ego, not to serve shareholder interests. And once caught up in that euphoria, paying an exorbitant price becomes an inevitable consequence. Imagine a company whose stock is significantly undervalued by the market compared to its intrinsic value. If management decides to use that very stock as currency to acquire another business at a price reflecting its true value, they are essentially exchanging $1 for half a dollar. That's value destruction in an instant. But on Wall Street, people still comfort themselves with all sorts of seemingly rational reasons. We need to expand market share. We need to diversify industries. We need rapid growth to keep up with competitors. I often smile and recall a sarcastic remark: "Never ask a barber if you need a haircut. The answer is always yes." Conversely, to deals that consume money and leave long-lasting consequences, there's a quiet but powerful tool: share buybacks. However, even here, wisdom and discipline are rare commodities. Many companies buy back shares merely to demonstrate confidence or to resist external pressure, even when the market price is much higher than intrinsic value. Doing so is like paying double for an item that isn't worth that much. What I always emphasize very clearly is that shares should only be repurchased when it genuinely benefits long-term shareholders, meaning the stock price is below true value and the company has no more urgent need for capital. If a business spends money on buybacks, but simultaneously has to incur debt or miss out on higher-yielding investment opportunities, that is a counterproductive action. A good manager knows when to say no to buybacks until the truly opportune moment arises. But when buybacks are done correctly, it's like a money-printing machine for the remaining shareholders, because each share removed from circulation increases their ownership percentage and the portion of value represented by each remaining share. This is simple, direct, and needs no embellishment. Yet many companies prefer to engage in complex games, such as paying greenmail to fend off hostile takeovers or making massive buybacks just to demonstrate their might. The ultimate result is often the silent erosion of shareholder wealth. In the 1980s, a craze swept Wall Street: LBOs, or leveraged buyouts. Huge loan packages were arranged by investment banks and funds, promising that if you borrowed enough, you could own any company. At first glance, it was a dream. But to me, it was no different from building a castle on sand. Those layers of debt transformed healthy businesses into crippled ships, weighed down by too much lead. Instead of being reinvested in production and innovation, cash flow now had to be used to pay interest and principal. Then, with just a gentle economic breeze, the entire castle would collapse. The LBO orchestrators might walk away with full pockets, but those left behind, employees, small shareholders, customers, would bear the consequences. I have repeatedly written that it was a game that benefited only a very small group, and the real economy gained nothing but the desolate carcasses of businesses. To understand what constitutes a good deal, we need to start with a simple principle: buyer and seller must both win. This sounds obvious, but in reality, many transactions are designed like a shootout, where one party tries every trick to maximize short-term gains, while the other is left with awkward commitments. Such buying and selling are like a forced marriage, grand at the signing, but full of bitterness when living together. At Berkshire, I always emphasize that we don't come to extract from the target company, but to continue a long journey with them. We don't force them into rigid frameworks, nor do we compel them to sacrifice their culture or working methods that led to their success. On the contrary, we often retain existing management, give them trust, and provide only what is necessary for the company to develop more smoothly. A wise seller thinks not only about the selling price, but also about where they entrust their spiritual child after years of nurturing. Perhaps that's why Berkshire has become the preferred choice for many older entrepreneurs or families who own long-established companies. They don't come to us to haggle over every dollar, but because they want continuity, wanting the spiritual values associated with their business to still be respected. In many letters, I have recounted how some deals came to Berkshire with just a handshake, not even requiring thick contracts, because trust was enough. People often ask, how do you know which company to buy? The answer is to look at the quality of operations, the integrity of management, and a reasonable price. If these three factors converge, failure is almost impossible. But if one of the three is missing, the risk magnifies many times over. There are great companies, but at too high a price. Buying them is like putting a lead weight on your chest. There are cheap companies, but with poor governance, which ultimately leads to a dead end. And there are well-run companies with dishonest leaders who sooner or later expose huge black holes in the books. In past deals, I always remember that long-term value is more important than short-term sparkle. When we bought See's Candies, we didn't just buy a few candy factories. We bought a brand with immense emotional power in the hearts of customers. The price at the time was not cheap, but the true value was so sustainable that we still enjoy the sweet rewards today. Conversely, there have been times when I had to restrain myself from opportunities that sounded appealing, but were actually traps. The market always offers bargains that look brilliant at first glance, but upon closer inspection, reveal themselves to be poor assets or businesses that require enormous capital to maintain their position. I've learned to say no even when countless voices around me were urging, yes. This discipline is the best protective barrier an investor can erect. There's a rather interesting paradox. Berkshire often buys companies but hardly ever sells them, almost throughout its entire history. We don't play the game of buying cheap and selling dear, like short-term trading. For us, owning a business is like finding a home you want to live in for life. You don't hunt for every house and then resell it after a few months. You only buy when you're sure you can stay forever. This steadfastness helps us avoid the disease of asset churning that has depleted so many listed companies. When I write these things, I don't intend to make Berkshire the only model. But it's clear that in a market where people often only look at short-term indicators, the philosophy of holding long and valuing highly becomes rare. It leads many entrepreneurs, when they want to entrust their businesses, to knock on our door first, rather than those financial corporations that always plan their exit strategy from day one. In essence, an acquisition is not inherently bad. It's only bad when driven by ego, by greed, or by the illusion that bigger is better. The truth is, a company is truly great only when every buying and selling decision is based on increasing real value for shareholders, not just to embellish the management's track record. One of the biggest illusions in the market is the belief that the more companies acquired, the more powerful the conglomerate becomes. The reality is the opposite. The more misguided deals a business takes on, the more it loses focus, its resources become diluted, and its culture erodes. Many one-star corporations have fallen simply because they viewed M&A as a sport, score as many points as possible. I often call it acquisition addiction. Some executives cannot stand the feeling of quiet. They always have to be doing something to prove their competence, to report to the board, to receive applause at annual meetings. And so, they rush from one deal to another like a gambler who doesn't know when to stop. But unlike a casino, here the money being bet is not theirs, but the shareholders'. This recklessness has incinerated countless fortunes. A memorable example is the dot-com bubble era in the late 1990s. A host of traditional companies suddenly plunged into buying tech startups, simply out of fear of being left behind. Prices at the time were so irrational that you could buy a company that had never made a profit for billions of dollars just because it had a catchy name or a flashy website. The result, everyone knows. The bubble burst. The giants that went hunting took decades to recover. In letters to shareholders, I have repeatedly emphasized that a deal should only be executed when it helps increase long-term value, not to make quarterly reports look good. If the sole objective is to be bigger, that is a path to tragedy. Meaningless expansion is no different from a person eating until they are morbidly obese. From the outside, they look large, but inside, countless diseases lurk. That's why Berkshire has always maintained an unshakable principle. We only buy when truly necessary and only buy what we understand. Many times I've been questioned why I missed this opportunity or that. The answer is simple. I don't need all opportunities. I only need a few right opportunities in my life and then to stick with them patiently. It's like not needing to catch every fish in the sea. You only need to catch the ones big and tasty enough to feed you for life. There's one detail I especially want to share with those in leadership roles. When you buy a company, you also buy responsibility for the people within it. That's not just an intangible asset on the balance sheet. It's thousands of families, thousands of stories. If you only see them as numbers, sooner or later, that coldness will backfire on you. Sustainable value cannot be built on indifference. When Berkshire acquired companies like GEICO, we didn't just calculate profits. We also considered whether their culture harmonized with our management style. GEICO had a dedicated team, loyal customers, and a clear operating philosophy. That's why this acquisition became one of our wisest decisions. If we had only looked at the numbers then, we probably would have missed that opportunity. Another paradox in mergers and acquisitions is, the fewer deals you do, the more likely you are to succeed. This might sound strange, but it's true. Every time we sign an acquisition agreement, it's usually the result of rejecting hundreds of other opportunities. It is precisely that patience that yields results. You don't need many hits to win, you just need a few precise hits. And this is the final message I want to leave in this section. In investing, as in business, the hardest thing is not finding something new, but knowing when to say no to what is wrong. A deal celebrated today can become a laughingstock tomorrow. Only discipline, honesty with oneself, and steadfastness to long-term value will help you stand firm. At Berkshire, we don't want to be predators, nor do we want to be show-offs. We simply want to be reliable partners, both for the companies we acquire and for the shareholders who trust us. That is the essence of every merger and acquisition decision we have ever made. Part 6, Valuation and Accounting. Long ago, Aesop told a simple but haunting story. A bird in the hand is worth two in the bush. Warren Buffett looks at the financial world and realizes that all valuation theories are no different from counting birds. Birds in hand, that's the cash you can hold, the cash flows a business is sure to bring you. Birds in the bush, those are illusions, distant prospects that people invent to justify sky-high prices. He calls this way of thinking inefficient bush-tillery. A thicket where investors frantically chase imaginary birds while ignoring the lively bird in their palm. No matter how smart, many investors at some point forget this elementary lesson. They are seduced by the prospect of 10 birds becoming theirs, and then spend money to buy businesses that have no certain ability to generate profits. Buffett emphasizes that intrinsic value can only be measured by the discounted present value of future cash flows. And if you buy something that doesn't have cash flow in hand, you're just hunting in the bush, where everything is uncertain. Intrinsic value, book value, and market price ***. Intrinsic value is the only compass you can trust. It is not a fixed number, not something obvious to pull from the balance sheet. Intrinsic value is like a living calculation, changing whenever projected cash flows or interest rates change. He writes, its nature is the discounted value of all the cash a business can generate for its owners over its remaining life. Book value is merely a reference point, sometimes useful, especially for financial companies like insurance or banks, where assets and liabilities reflect reality more closely. But for most other industries, book value is just an illusion of accounting numbers. Market price, of course, is a game of emotions. Sometimes the price is much lower than intrinsic value, sometimes it's many times higher. Buffett warns, if you confuse these three, you will soon pay the price with your own wallet. A business can report steady accounting profit growth, but if actual cash flow weakens, intrinsic value still declines. Conversely, some companies have unimpressive book values but stable and growing cash flows, and that is the intangible asset that the balance sheet cannot record. From there, Buffett introduces a concept he considers a magnifying glass: look-through earnings. He does not accept the GAAP accounting method that forces Berkshire to only recognize profit when dividends are distributed if Berkshire owns less than 20% of a company. This, for Buffett, is a serious distortion, so he recalculates. Berkshire records its percentage of profit from that business, even if that profit has not been distributed, after deducting hypothetical taxes. He calls this look-through earnings, a concept that helps to see directly into the economic health of investments rather than just reading numbers dictated by accounting. Goodwill ***. In accounting language, goodwill is simply the difference you pay above book value when acquiring a company. But Buffett clearly distinguishes between accounting goodwill and economic goodwill. Accounting goodwill can fluctuate, even be written off if regulations change. But economic goodwill, a business's ability to generate superior profits due to brand, network, or sustainable competitive advantages, the true value. He emphasizes that investors can only understand a business if they differentiate these two types of goodwill. Owner earnings ***, the actual profit flowing into the owner's pocket. His calculation differs significantly from standard practices. According to Buffett, owner earnings equals net income plus depreciation and other non-cash charges, minus capital expenditures necessary to maintain competitive capacity. This is a crucial point. Many people calculate free cash flow but overlook this necessary capital expenditure. They think depreciation is a paper expense, so they add it back to profit, but forget that machinery, infrastructure, and technology all require reinvestment for the company to survive. He calls that cash flow fallacy, a dangerous misconception about cash flow. Investors are easily lulled by beautiful numbers, imagining the company is generating mountains of money, but in reality, it's eating into its own health. Only when you correctly calculate the capital required to maintain competitiveness can you see the true amount remaining for the owners. And it is precisely owner earnings that is the golden standard Buffett uses for valuation. After explaining owner earnings, Buffett continues to point out accounting traps that investors often fall into. One of them is blindly focusing on reported profits. He emphasizes that reported profit is only a starting point to understand true value, not the ultimate goal. For insurance companies, this industry often has to retain large reserves to pay for future losses. If you only look at reported profits, you might think the company is doing well. But Buffett warns that if reserves are insufficient, those beautiful numbers are just illusions. The important thing is to assess the reasonableness of the assumptions made in setting reserves, a much more difficult task than reading a few lines in a financial report. Buffett also points out how many companies use accounting to sugarcoat results *. For example, they might delay recognizing expenses or accelerate revenue recognition before the due date. This creates an illusory picture that boosts stock prices in the short term. But ultimately, when the truth is revealed, intrinsic value and market price will converge, often with a disastrous fall. That's why he emphasizes his special analytical tool, look-through reporting, reading financial statements from the perspective of an owner. For Buffett, an investor is not an outside observer, but must put themselves in the position of the company's owner. Only then will you ask the right questions. How much money truly flows into my pocket? How much capital does the company need to maintain its competitive advantage? Will today's profits be sustainable for tomorrow? Going further, Buffett discusses a concept he frequently uses in valuation: the economic moat *. He analyzes the difference between a company that must constantly reinvest to maintain its position and a company that possesses an economic moat, the ability to generate superior profits without requiring too much additional capital. The classic example Buffett gives is Coca-Cola. Coca-Cola's brand is so strong that even if the company doesn't continuously inject huge capital, it still maintains its appeal and generates superior profits. In this case, economic goodwill is an intangible asset with more power than any factory or production line. To emphasize this difference, he contrasts asset-heavy businesses, those needing enormous physical capital to maintain an advantage, with asset-light businesses, those relying on brand, know-how, or network. He advises investors to identify which type creates sustainable value, as this determines future capital requirements, thereby directly affecting owner earnings. Buffett also dedicates many pages to analyzing the difference between ** accounting and economics *. In accounting, the concept of profit can be influenced by regulations, rules, and conservatism. In economics, profit is a real cash flow, actual money you can use, reinvest, or pay to shareholders. A wise investor is always ready to translate accounting reports into economic language. Another important point Buffett discusses is ** patience **. Many investors, when they don't see the stock price immediately reflect intrinsic value, hastily sell. But Buffett emphasizes that the market in the short term is a voting machine, but in the long term it is a weighing machine. Eventually, intrinsic value will reveal itself. He writes, "Your job is to accurately value the business. The market will do the rest." He then returns to a metaphor he loves: look through earnings as an X-ray. Imagine you only look at the superficial image. That's a standard financial report. But when you use look-through earnings, you are X-raying, seeing the bones, blood, and internal organs of the business. This perspective can be difficult, but it allows you to see the true health. Buffett also warns that many Wall Street analysts are * accounting blind. They are busy predicting quarterly profits, issuing buy-sell recommendations, but forget that valuation must stem from long-term economic strength. Short-term forecasts are like chasing birds in the bush. He emphasizes, forget the daily market temptations. Focus on accurately reading intrinsic value. That is the art of investing. Buffett dedicates a significant portion to ** depreciation and the detrimental misunderstandings surrounding it. According to him, there are cases where depreciation is merely an accounting number, but there are also times when it is a real expense that drains cash flow from a business. Many companies often cheat by deliberately reducing depreciation to make profits look better. But as Buffett warns, that's just a game of self-deception. He states clearly, when assets truly wear out, you cannot just type on a keyboard and bring them back to life. You must spend cash to replace them. A wise investor needs to distinguish between paper depreciation and real cash depreciation. Related to this, he delves into ** capital expenditures, CapEx. This is the crucial distinction between average companies and great companies. If a business constantly has to inject capital just to maintain its profit level, then each dollar of that profit isn't worth much. Conversely, if a business can sustain profits without much CapEx, then the surplus cash flow is truly a treasure. Buffett emphasizes, what excites us is not reported profits, but the cash flow remaining after deducting all necessary CapEx. Buffett then discusses ** intangible assets *, such as brands, patents, or loyal customer networks. By accounting standards, these assets are often undervalued or even absent from the balance sheet. But Buffett asserts that the true power of many companies lies here. He cites examples from Berkshire's major investments, where intangible assets were the decisive factor in generating enormous profit margins and the business's resilience. He calls this hidden value, a value that investors must have a special eye to recognize. In a very sharp passage, Buffett criticizes the mechanical use of the *P/E ratio*. He argues that P/E is only a superficial indicator. If one doesn't understand the essence of owner earnings, goodwill, and CapEx, P/E only leads investors further into illusion. Some companies with high P/E ratios are worth far more than those with low P/E ratios. because they have the ability to generate superior cash flow, require less capital, and are sustainable. According to Buffett, the real job of an investor is not to hunt for low PE, but to value future cash flows with clear-headedness. It's interesting that Buffett doesn't just talk about theory. He repeatedly mentions Berkshire's deals, such as acquiring stakes in global consumer companies. In these cases, the stock prices might seem expensive to outsiders. But when viewed through the lens of owner earnings and economic moats, Buffett realizes they are cheap in a long-term economic sense. Conversely, he has also seen many cheap bargains that turned out to be traps, because the business constantly consumed capital and its competitive advantage was fragile. Buffett also dedicates space to explain a principle he and Charlie Munger apply thoroughly: accounting noise, ignoring accounting noise. They don't pay much attention to non-cash items like valuation adjustments or asset mark-to-market. These fluctuations only confuse investors. What they look at is the ability to generate real cash. Valuing a business is the art of reading the flow of time. Accounting gives us a static snapshot, while intrinsic value is a long-running movie. A wise person never confuses the snapshot with the entire film. Simplicity is often the key. Complex valuation models, full of formulas, are often less reliable than a few simple questions. Does this business have a sustainable advantage? How much capital is needed to maintain it? How much real cash flow actually goes to shareholders? Buffett confesses that he and Charlie frequently pass on companies that are too difficult to understand and only choose what is clear. Valuation is not a game to show off cleverness, but a journey to seek clarity. Part 7. Accounting Shenanigans. When looking at financial statements, many people imagine they are reading an honest diary of a business, where every number is a sincere footprint on the business path. But I have lived too long not to believe in such naivety. I have seen numbers morph and dance like magicians on stage, leaving the audience feeling they have witnessed a grand feat, but in reality, it was just a trick. Benjamin Graham, the teacher I always respected, once wrote a satirical piece where, with just a few bookkeeping tricks, a fictitious company could become a profit superstar without a single additional dollar of real cash. He described accounting managers holding pens like magic wands, turning losses into profits, failures into achievements. And the painful truth is that this was not just satire. I have seen it in real life, where countless companies, big and small, want to present themselves more favorably to Wall Street. People call it earnings management. It sounds sophisticated, but in reality, it's just putting on lipstick and powder on a wrinkled face. The then SEC chairman, Arthur Levitt, strongly warned that this practice was becoming a disease in American business, and he was right. Because when financial reports are no longer factual, they become collective fraud. It's not just a story about a few numbers, it's a story about betrayed trust. Stock options. If you compensate management with cash, you have to record it as an expense. So, if you compensate with options, why not? This question is so simple that even a child can understand. Options allow management to take potential profits from shareholders. That is a cost, a very real cost. Yet, for years, countless companies refused to acknowledge it. They pretended as if issuing options did not reduce the company's value, did not eat into shareholder benefits. This pretense became so widespread that it almost became an unwritten standard. I clearly remember one time we decided to stop granting options at General Ray. Instead, we paid compensation with cash, transparently and simply. Many objected, saying we would lose our appeal to talented young leaders. But I believed the opposite. If someone is only attracted by the opportunity to profit at the shareholder's expense, they are not worthy of leading this company. But options are just one act in a larger play, another act named restructuring charges. Initially, these were designed to record unusual, non-recurring expenses to make financial reports clearer. But then, like any tool in the hands of the cunning, it became a gimmick. In 1998, it was reported that there were 1,369 special charges, totaling $72.1 billion. Imagine $72 billion being removed from core profits simply by a non-recurring label. And the next year, the same game repeated, even magnified. If you're sitting at a dinner table and see someone constantly pushing the fat to the edge of their plate, saying, "Don't worry, I'm only eating the lean part," would you believe they won't gain weight? Yet, in the financial world, many investors believe in that fat-pushing trick. They look at the adjusted profits and feel relieved, while the juicy truth remains right on the plate. Assumptions about pension fund returns. Many companies calculate as if money in pension funds will grow at 8% annually, regardless of actual market conditions. To achieve an 8% total return, the stock portion of the fund would have to earn 9.2% after fees, an unrealistic long-term rate. Yet, thanks to these rosy assumptions, companies can report higher profits because their pension contribution expenses are understated. Once again, numbers are turned into cosmetic makeup. And there's one final act that few outside Wall Street pay attention to: realized gains and losses. Imagine you hold a portfolio of securities, some with gains, some with losses. If you wish, you can just sell the gains, keep the losses, and immediately your reported profits look bright as day. Or conversely, if you need to clean up to prepare for a good quarter, you sell the losses, dumping all the bad news into one period to make subsequent periods shine. All of this is legal, but all are misleading tricks. I have repeatedly emphasized to Berkshire shareholders, our quarterly net income numbers don't mean much. With just a few buying and selling moves, they can fluctuate wildly like a leaf in the wind. Far more important are operating earnings and the growth of book value. That is the true mirror, reflecting the company's health. But accounting magic doesn't stop there. It also manifests in other red flags. When management starts praising EBITDA and downplaying depreciation, be wary. Depreciation is not an abstract number. It is the real wear and tear of assets. When reports are full of special items or when financial footnotes become long and obscure, be cautious. And when executives constantly promise to hit earnings targets, as if profit is a product of willpower rather than business results, retreat. These are unmistakable signs. In my investing life, I have learned that numbers are not always the truth, but the truth is always hidden in the numbers. The problem is knowing where to look. Accounting shenanigans usually cannot be hidden forever, like a small crack in a wall. Initially, people might paint over it, but then rain and wind will cause it to spread, and the truth will be revealed bare. Recall a painful historical example: Enron. That company was once hailed as a model of American innovation, glorified on magazine covers. But then, in a short time, everything collapsed. The cause: balance sheets filled with special-purpose entities designed to conceal debt and inflate profits. Not every investor realized it because the reports were beautifully presented, very compliant. But beauty here was a fake beauty, like a mask painted with gold and crimson. When it fell, inside was only decay. Many people lost money, many employees lost jobs, many families were ruined by this fraud. And the even higher cost was the loss of trust in the market. That is something anyone who respects professional ethics must shudder at. If I had to choose between achieving enormous profits by bending standards and earning less, but doing it honestly, I would choose the latter without hesitation. Because a business can only survive long if built on a foundation of trust. Deceptions, no matter how sophisticated, are just like building a castle on sand. It might look magnificent at first, but with just one wave, it all collapses. Some also justify it by saying it's merely accounting creativity, the necessary flexibility to reflect reality. I call that self-deception. Accounting is not a place for creativity. Art can be found in painting, music, sculpture, but in accounting, the more creative, the more dangerous. The job of accounting is to reflect economic reality, not to weave stories. Once I was asked, "Mr. Buffett, how can an ordinary investor detect shady accounting tricks?" We don't have the expertise of auditors. My answer is always simple: pay attention to motives. If management is rewarded for short-term profits, be vigilant. If the company constantly emphasizes adjusted metrics, ignoring obvious expenses, be suspicious. If in the annual report the explanations become increasingly long but harder to understand, then perhaps something is being hidden. A good company doesn't need too many words. Like a well-crafted musical instrument, it produces a clear melody with just a pluck of a string. But a bad company, no matter how many flowery words you wrap it in, its sound will still be harsh and off-key. I clearly remember when Berkshire owned Coca-Cola. Their profits didn't need embellishment. Just by looking at the number of Coca-Cola cans sold worldwide, you knew the true value. No special restructuring charges, no adjusted profits, no rosy assumptions about pension funds. That was the transparency that any investor would feel secure with. Conversely, when I looked at some telecom conglomerates during the dot-com bubble, the huge reported profits were accompanied by massive debt. EBITDA earnings before interest, taxes, depreciation, and amortization was hailed as a measure of health, but EBITDA is just a false promise. It ignores capital expenditures, ignores asset depreciation, ignores what truly matters. You cannot pay interest with EBITDA. You cannot reinvest with EBITDA. But many investors were drawn into that illusory number until the bubble burst. I wrote to Berkshire shareholders to be wary of CEOs who consider EBITDA a primary metric. Once you see them preaching EBITDA, turn and walk out the door. Because when a leader wants you to forget depreciation, they want you to forget a truth. Physical assets wear out, and replacing them requires real cash. In reality, there are no miracles in business. Value is only created by serving customers better, operating more efficiently, and using capital wisely. Accounting magic tricks might make stock prices soar for a while, but eventually, the truth will strip everything bare. As Graham once said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine, and that weighing machine never forgives. One of the tricks I am always wary of is how companies classify expenses. Many businesses try to shift expenses from recurring to one-time. It sounds reasonable. Unusual expenses shouldn't be counted towards annual profits. But try to observe closely. If a company has a long list of one-time items every year, are they still unusual? That is a common sophistry. Imagine you manage a store. The first year you say the cost of roof repair is unusual. The second year you call the cost of replacing the refrigerator unusual. The third year you call the cost of upgrading the electrical system unusual. Eventually, unusual becomes usual. If you remove those expenses from the financial picture, you are painting a dream store that doesn't exist in real life. I often tell Berkshire shareholders that transparency is not an option, it is the foundation. A good company will not try to distract investors with customized metrics, rosy stories, or flowery names for expenses. Instead, they will present the naked truth. Here is the revenue, here are the expenses, here is the profit, no embellishment, no concealment. The sad truth is that the stock market always holds an appeal for those skillful with language. A new phrase, a cleverly redefined financial report, can excite the crowd. But remember, words don't create cash, only real business operations do. Another example I often cite is intangible assets. There's nothing wrong with this concept. Brands, patents, distribution networks are all invaluable assets. But if management starts inflating intangible values to cover up poor business performance, that is a dangerous sign. Coca-Cola has an enormous brand, but what makes it valuable is the billions of cans of soft drinks consumed every year. A brand is only meaningful when backed by actual purchasing power. So I always tell shareholders, focus on owner earnings, the actual cash flow belonging to the owners after deducting all maintenance costs. Reported profits can be bent, but cash flow is harder to conceal. You can adjust a report, but you cannot pay dividends with numbers on paper. Read the annual report like a detective novel. Don't just stop at the headlines. Scrutinize every detail, every footnote, every tiny word. It's in those tiny footnotes that you will find the truth. A transparent company will tell you everything fully. A dishonest company, the more carefully you read, the more inconsistencies you will find. Accounting should be a mirror, not a paintbrush. If a company is honest, you will see clarity, simplicity, and ease of understanding in its reports. If a company is dishonest, you will see thick layers of paint, glossy jargon, and endless adjusted numbers. The market can be fooled in the short term, but the truth will prevail in the long term. And when the truth is revealed, only honest companies will stand firm. Part 8. Accounting Policies. When you read a financial report, do you truly know what it's telling you? Many believe those numbers are absolute truth, as if everything is carved in stone. But in reality, the report is merely a painting created according to certain rules. And sometimes, the painter deliberately uses colors to make the picture look more brilliant or, conversely, gloomier than reality. In this section, I want to draw you closer to those rules. what we call accounting policies, to clearly see how they can shape, even distort, your understanding of a business. Let's start with a familiar story in the investment world: mergers and acquisitions asterisk. Imagine you are witnessing two large companies embracing each other. A strong entity is swallowing a smaller one. What do you expect? Of course, synergy, the magical 1 + 1 = 3 that CEOs often mention in their presentations. But when you look at the financial report after the merger, what you see might be far different from expectations. Why? Because, simply, there are two completely different accounting paths to record this transaction: purchase accounting asterisk and pooling of interests accounting. With purchase accounting asterisk, the acquiring company must record the assets and liabilities of the acquired company at their current market value. Any difference exceeding tangible assets will be recorded as goodwill, a type of intangible asset representing brand, reputation, or expected future profits. This goodwill is then amortized gradually over time, and that amortization reduces reported profits each year. In other words, purchase accounting can make profits look worse in the short term, even if the deal truly brings long-term benefits. Conversely, with pooling of interests accounting asterisk, the two companies simply combine their reports. No goodwill, no amortization. Reported profits look much better. But better here is only on paper. It's like combining two accounting ledgers into one without recording what you had to pay to acquire them. Pooling of interests accounting easily lulls investors into the illusion that the deal went smoothly without any associated costs or risks. Do you see the paradox? The same deal, just by choosing a different accounting method, the profit picture completely changes. So, a smart investor must be able to see through that decorative layer to grasp the true nature: how much value the company has actually created, regardless of what the reported numbers say. Moving to the second story, segment reporting asterisk. A large conglomerate is like a giant ship with many compartments. Some cargo compartments are generating enormous profits, but others are leaking and draining money. If you only look at the aggregate numbers gross revenue, gross profit, you will never know which part of the ship is truly strong and which is weak. That's why I always demand transparency in segment reporting. A classic example: imagine a company with two segments, an insurance segment and a shoe manufacturing segment. Insurance earns billions, while shoes only earn enough for shoelaces. If reports are combined, the company appears to be operating extremely strongly. But without separation, shareholders would never know that half the company is living on the breath of the other half. Worse, concealing data from individual segments provides management with a mask. They can exaggerate achievements by blending good results with failures. Meanwhile, the truth is, shareholders deserve to know where their company is healthy and where it is struggling. I often say, the more a company fears disclosing segment data, the more I suspect its true health. Because transparency is always the companion of confidence. Concealment only arises when there is something to hide. One of the most subtle deceptions in financial reporting, often overlooked, is asterisk deferred taxes asterisk. It sounds dry, but let me tell it another way. It's when a company enjoys a lavish meal today but doesn't pay immediately. Instead, it tells the restaurant, "I'll pay tomorrow." In reality, tax laws and accounting standards often don't speak the same language. Tax laws operate on their own principles, while accounting aims to reflect economic profits based on accrual principles. The result is that companies might report having earned profits, but for tax authorities, those profits haven't yet arisen. For example, asset depreciation. According to accounting, machinery might be depreciated evenly over 10 years. But tax law might allow accelerated depreciation over just 5 years to encourage investment. In that case, on the accounting books, profits look higher, meaning more tax should be paid. But for tax authorities, accelerated depreciation results in lower taxable income, meaning the company pays less actual tax at that moment. This difference creates what is called deferred tax. There are two sides to this story. If it's a deferred tax liability, it means the company knows it will have to pay more in the future, but today it comfortably keeps the money in its pocket, like an interest-free loan from the government. If it's a deferred tax asset, it means the company can use past losses or tax incentives to reduce future obligations. This sounds like an advantage, and it is when the company manages cash flow intelligently. But for investors, the question that needs to be asked is whether those deferred tax assets truly provide value or are just lifeless numbers recorded on paper. Because if the company never generates sufficient taxable profit, these assets will remain there, never transforming into real money. Remember, $1 of deferred tax is not the same as $1 of cash. It's just a promise of potential future savings. Current cash flow, however, remains unchanged. And in investing, we must clearly distinguish between real money and paper money. Moving to another troubling topic, employee pension benefits asterisk. Imagine you are a shareholder in a large steel company. Today, the company reports positive profits. Dividends look very promising, but hidden beneath, the company carries a colossal obligation to pay pensions, health insurance, and benefits to tens of thousands of retired workers. These expenses don't appear immediately in the current year, but like an undertow, they could swallow the ship in the future. Pension obligations are calculated based on assumptions: discount rates, average life expectancy, how much medical costs will increase each year. Just by changing a small number in the assumptions, the entire obligation could swell by billions of dollars. And of course, management tends to choose the most favorable assumptions to make the obligation appear lighter. For example, if the company assumes that discount rates over the next 20 years will remain high, the present value of pension obligations will decrease. But suppose actual interest rates are much lower. The company will face a huge pension fund deficit, something shareholders only realize when it's too late. Historically, many corporations have almost gone bankrupt under this burden. Reported profits were positive, but in reality, if all pension obligations were accounted for, the company was eating into capital instead of creating new value. That is one of the reasons why, when I read financial reports, I always scrutinize the footnotes, where companies are forced to disclose these long-term commitments. The lesson for investors is very clear. Don't just look at current profit numbers. Ask how much more this company has to spend on its former employees before it's the shareholders' turn to receive a share. When reading financial reports, many people stop at the first few pages: the balance sheet, income statement, cash flow statement. But the truth is, the meat of the book lies at the end, in the footnotes asterisk. Consider footnotes as secret appendices. That's where the company is compelled to reveal details that the superficial numbers have deliberately concealed. Here you will find the accounting methods applied, details about guaranteed debts, off-balance sheet commitments, revenue recognition policies, legal disputes that could cost the company hundreds of millions of dollars, or simply financial assumptions that, if changed, would reverse the entire profit picture. In fact, I often spend more time reading footnotes than the main financial statements. The reason is that the real story is always buried there. A beautiful profit figure on the main report can quickly become meaningless when the footnote reveals the company is deeply mired in debt or facing unpayable pension obligations. In other words, if the financial report is the face, the footnotes are the heart, liver, and internal organs. To understand the true health of a business, you must look inside, however unpleasant it may be. Sadly, most investors ignore footnotes. They rush to make decisions based on EPS, PE, or free cash flow without checking what those numbers are built upon. That's precisely when they become prey to accounting magic tricks. And I want to emphasize this: a financial report is never absolute truth. It's just the story management wants to tell. The truth, sometimes rough, sometimes harsh, lies in the small print at the end. When you learn to dig deep into footnotes, you will realize one thing: transparency never comes for free. The more transparent a business, the more honest it is in admitting difficulties, obligations, and risks, the more it deserves trust. Conversely, when encountering a company that conceals, writes vague footnotes lacking detail, or constantly changes its accounting policies, that is a red warning sign for the alert investor. Reading financial reports is like being a doctor. Don't just look at a rosy face and conclude the patient is healthy. Test the blood, check the heart, liver, and lungs, meaning read the footnotes. Only then will you know if the business's body is truly healthy or harboring an unpredictable disease. Part 9. Tax issues. If you've ever owned a business, you know this feeling. Ultimately, it's not the pre-tax number, but the money left in your pocket that determines the game. The market can debate endlessly about PE, growth models, or gross margins. But when the curtain falls, the owner is left with one very earthly question. After tax, how much did I really get? I write these lines after decades of grappling with U.S. tax law and signing tax checks every year large enough to make the faint of heart tremble. Berkshire is one of the largest taxpayers. That makes me respect a simple truth. Taxes are a real cost. You cannot reason with them, and you should not sugarcoat them. The only correct approach is to look directly at the after-tax consequences of every decision. When you value a business, you are valuing the cash flows it can pay to its owners, not paper numbers. Therefore, any change in tax law can shift value, even if business operations remain unchanged. Many years ago, the repeal of a once familiar privilege, the principle, allowing asset distribution upon liquidation without corporate-level tax, closed a door. From that point, ending a company's life through liquidation incurred tax at the corporate level and then again at the shareholder level. That double-edged sword cut directly into the owner's pocket. It didn't degrade machinery, brand, or customers, but it cut into the net value shareholders could take home. You cannot pretend it doesn't exist just because you don't like it. You can only incorporate it into your model, calmly deduct it, and refuse to pay a price as if it weren't real. So who bears the corporate tax burden? The sad answer is the names that never appear on the tax bill: shareholders through reduced profits, employees through slower wage increases, and customers through higher prices when costs can be passed on. The burden shifts over time and competitive context. It doesn't stop at any single statement, but in the end, it arrives, like all other costs, where the weakest point of resistance is in the business's ecosystem. If taxes are so heavy, should they drive every decision? My answer is always the same. No. Taxes are like gravity. You must account for them, but you cannot let gravity decide where you go. An economically meaningless deal will not become wise just because it saves taxes. Conversely, an economically sound decision should not be killed just because it incurs too much tax. The tax tail must not wag the economic dog. I value tax deferral, but only when it is a natural consequence of holding a good asset. We love long-term holding partly for compound interest, partly for taxes. When you don't realize capital gains, you defer the moment of writing a check to the Treasury, allowing the money to continue working for you for many more years. But note this from me: deferral doesn't mean evasion. Eventually, if you sell, you still pay. Therefore, the benefit of tax deferral is only meaningful when the core economics of the asset are strong enough to warrant the time you allow it to stay. Tax structures also vary depending on ownership position. When you hold below a certain threshold in a listed company, the dividends you receive are subject to one set of rules. When you own more, especially with control, the picture changes. The ability to consolidate for tax purposes and the rules for internal cash flows transform obstacles into pathways, but only for those who truly own the business, not just surf a listed paper. I don't advise anyone to acquire control solely for tax reasons. I only remind you that your after-tax map must reflect the true terrain, not just desire. There was a time when the proportion of corporate income tax in total federal revenue dropped from a historical peak to a modest level. Many people quickly drew conclusions about who was bearing the burden. I, however, am not so quick. Those numbers tell a long story about cycles, loopholes, and changes in the economy's profit structure. What I care about is more practical. When I buy $1 of pre-tax profit, after all the barriers, what am I left with? And is there any legal, straightforward way for that after-tax number to get closer to $1 in the shareholder's pocket? I want to dispel the illusion that one can get rich sustainably through tax games. I have seen too many people make sophisticated calculations only to lose sight of the most basic thing: the quality of the asset behind the numbers. Don't build your strategy on legal footnotes. Build it on businesses that can make money even when laws change. At this point, you might conclude that our tax philosophy is bland, honest, cautious, and patient. That's right, it doesn't have fireworks, but it is something more precious: time on its side. And in investing, when time is on your side, the rest often falls into place. Over decades, I've realized something seemingly simple that many still forget. After-tax profit is the compass that guides all capital allocation decisions. In the boardroom, people are easily swayed by smooth charts, but out there, the Treasury only looks at checks. Therefore, when discussing how we choose between retaining cash, paying dividends, buying back shares, or making an acquisition, I always start with the only correct question. After passing through the tax system, how much net value does each option leave for shareholders? For instance, dividends are the most straightforward answer psychologically. They put money directly into owners' pockets. But this obvious benefit comes with a clear, measurable tax cost for many shareholders. Capital gains are taxed one way, dividends another, and the accumulation rate of $1 received today is very different from $1 remaining in the company, continuing to work without immediate taxation. Therefore, we only consider paying dividends when we are certain that every dollar retained cannot create at least $1 of market value. If it doesn't pass that test, the money should return to the owner. If it does, don't let habit or Wall Street noise force you to pay out just to satisfy a single quarter. Share buybacks are the second option, and under the right conditions, are often a more tax-efficient way to return money to shareholders than dividends. The seller accepts to realize their own tax liability. The remaining shareholders increase their ownership stake without incurring immediate taxes on that increased portion. But under the right conditions is an iron barrier. Only do it when the market price is below intrinsic value and after ensuring all necessary capital needs are met. Buying back shares to create an EPS effect or to mask business problems is the quickest way to turn a tax advantage into a tax trap. When discussing asset sales, the after-tax problem is even more stringent. Selling a poor business to free up capital for a better opportunity is something we don't hesitate to do. But selling an excellent business just to lock in gains is something we rarely do, not just because of emotion, but because of arithmetic. Each time you realize a gain, you close off a stream of compound interest that is reluctantly lending you money from the Treasury. That compound interest, if allowed to continue running in an excellent asset, will far exceed the deferred tax you deliberately awaken early. In other words, tax deferral only makes sense when you are sitting on a durable money-making machine. Otherwise, deferral is just delaying disappointment. Taxes also redraw the map of priorities among investment options. Suppose you have two choices before you that are identical pre-tax, but one promises to generate steady cash flow taxed annually, while the other defers its rewards further into the future. If the economic quality of the two opportunities is equal, the tax deferral machine will often win by allowing compound interest to work longer before the tax collector knocks. That said, tax is not the only compass. I have often reiterated that the tax tail must not wag the economic dog. We don't buy a bad business just because its tax structure looks smart, nor do we avoid a good business just because it offers no tax tricks. The right attitude is to put economics first, and then write the tax chapter in its proper place in the story. The most enduring tax advantage I know to date is as old as Earth. A superior business model, plus long-term holding, plus minimal unnecessary shareholder transactions. The after-tax problem also applies at the individual level. Some are in high dividend tax brackets, some optimize for long-term capital gains, some invest through different tax vehicles. I cannot write for everyone, but I can promise this. If Berkshire continually increases intrinsic value per share and you patiently hold, then no matter how tax policies change, we both stand on the same side of the equation. Your after-tax returns will follow the upward slope of intrinsic value, not the jagged line of quarterly results. Sometimes people ask me about tax fairness. I have no ambition to be a legislator, but as a large taxpayer, I believe in straightforwardness. We pay our share, and we thrive in that environment. I also believe that tax systems will continue to change in cycles and political contexts. The investor's job is not to regret the past, but to understand current rules well enough not to shoot themselves in the foot. If your business only thrives when a temporary clause exists, then perhaps that is not the business for you. I want to close this section with an image that has haunted me all my life. Tax is gravity. It is not malicious. It is just always there. A truly good airplane does not demand that gravity be reduced. It is designed to fly within gravity. A good investment strategy is the same. Accept tax as a natural condition. Then simplify what you can control, costs, turnover, and the habit of chasing the new. The most important part, as always, is choosing the right value-creating machine and letting time do its part. When I look back at my long years with Berkshire, most of the best decisions shared three characteristics: sound economics, simple transparent structure, and patience with after-tax compounding. There is no secret formula outside these three things. If you grasp them, the rest of the book on tax becomes a few appendices. If not, even a library of laws won't save you from yourself. I have said enough about tax, not to make you love it, but so you know how to live with it, calmly and effectively.